Hi, I'm Steve LaFrance with Blakely Financial, and I'm summarizing the past 30 days in 3 minutes. Stocks and bonds both rallied in July after selling off during the second half of June due to recession fears. Riskier asset classes such as small cap stocks and high yield corporate bonds outperformed as investor sentiment turned slightly more positive. If you're interested in the raw market performance numbers, simply pause this video to view figures 1 and 2 for July returns, figures 3 and 4 for year-to-date returns, and figure 5 for total market data. So why the change in attitude? Multiple catalysts could be causing the turnaround, one of which includes investor sentiment being too negative entering July. Earnings season kicked off during the month, and early results suggest Wall Street's expectations were too low. While the rate of growth is slowing, the overall tone appears to be less bad than feared, with commentary from companies more optimistic than expected. One interesting narrative starting to show up in the headlines is that weak economic growth could cause the Fed to stop raising interest rates sooner, which could boost investor sentiment and relieve pressure on stocks and bonds. Data indicates the economy shrank during Q2, which marks the second consecutive quarter of negative GDP growth, which is the technical definition of a recession, and now the prospect of a shorter interest rate hike cycle will be hotly debated over the coming months. As we all know, Congress has given the Fed a dual mandate to pursue price stability and maximum employment. But what does this mean? The Fed defines price stability as approximately 2% annual inflation, but maximum employment is more difficult to define because it's a broad-based and inclusive goal that is not directly measurable and changes over time. So where is the Fed focused now? Obviously, price stability. CPI accelerated 9.1% year over year during June, which was the fastest pace since 1981. In contrast, the unemployment rate held steady at 3.6%. The Fed's rate increases are intended to control inflation by reducing demand for goods and services, but comes with the embedded risk of slowing the economy and increasing unemployment, which may pressure the Fed to focus more on employment and less on inflation. This begs the question, which is more important? The Fed previously stated it's willing to accept higher unemployment and slower growth to bring inflation under control, but by how much? A lower tolerance for unemployment could cause the Fed to slow or stop its interest rate hikes sooner, while a higher tolerance for unemployment could give the Fed cover to continue raising interest rates higher and longer. The answer has major implications for both Fed policy and asset class returns, so we'll continue to keep an eye on this, and hopefully the markets will maintain a more optimistic posture. Meanwhile, thank you for your trust and confidence.